Zambia is cutting out Western trading houses. Its state mining arm is setting up its own metals trading desk so that it can sell copper directly instead of relying on firms in London or Switzerland. That is a shift in who captures value. Copper is roughly a $180 to $200 billion a year global mining market, producing around 22 million tons annually. It runs power grids, broadband cables, rail systems, and factories. I'll put some perspective on it, right? An electric car uses up to 3 times more copper than a petrol car. Wind farms and solar networks are copper heavy. The International Energy Agency says that mineral demand linked to clean energy could at least double by 2040 under current policies. Copper is globally priced on exchanges like the London Mineral Exchange, so Zambia itself cannot set the world price. But what it can control is the trading margin, the financing spread and the customer relationship that usually sit with intermediaries. Supply is concentrated, right? Chile produces about a quarter of global copper. Peru and the Democratic Republic of Congo are each around 10%. China produces about 8%, but consumes more than half of global refined copper. Zambia produces roughly 3%. So it isn't exactly the biggest global muscle, but copper for them makes up 70% of Zambia's export earnings, often $6 to $8 billion a year. Zambia defaulted on its sovereign debt in 2020 and is restructuring. For Chile, copper is huge. For Zambia, copper is critical to currency stability, debt repayment, and public spending. And that is the real stake here, right? If Zambia captures more margin, it strengthens reserves. And if it mismanages risk, it weakens the balance sheet. Copper prices have traded below $5,000 per tonne and above $10,000 within the past decade. Volatility is real. Trading requires deep credit lines, disciplined hedging, strong governance, and low-cost financing. About a third of global supply also comes from recycled copper, which limits long-term pricing power. And while moving up the value chain captures more income, it does not fix concentration risk. Zambia is still exposed to one commodity cycle. But here's a forward play for you to think about, right? If the energy transition accelerates and supply struggles to keep up, copper could actually enter a sustained deficit later this decade. In that scenario, producer leverage rises and those controlling both production and trading capture more upside. The question is timing and execution. Like, build the capacity before the cycle tightens, and this looks strategic. Miss the window, and it becomes expensive ambition. In a market